the stock exchanges offers platform in a more particular way to enable capital raising. But with the world changing, we've seen the landscape and the ecosystem fast changing, and we are having other competing platforms as stock exchanges. There's also a need to actually blend the financing needs of the private sector or even governments in order to be innovative enough to fulfill their capital raising needs. And therefore, I think it's quite fitting that this becomes the first panel discussion, because it is the traditional rule that stock exchanges existed over the years.
I would like to tell you that pension schemes are slow in decision making by nature. So don't come in a rush to raise capital. Do advanced sensitization. Come around for book building in advance, and don't bypass the fund manager and go to the trustees. You will be referred back to us, and that at times leaves a bad taste in our mouths on that. And then also be upfront on certain disclosures. We have seen in the past somebody saying this is a guaranteed bond. But when you go and read the small print, it is only partially guaranteed. And even to get paid up can even take 3 or even 4 years. And also just understand pension schemes. Yes, they are long-term investors, but they have to survive the short term to get to the long term because of their yearly reporting to members.
What do you think is the impact of regulation in making exchanges uncompetitive? Do you think regulation is too much? Do you think we should relax regulation? At what point do you think we need to strike the balance in order for us not to become irrelevant or to be outcompeted by other platforms?
I think we have to strike the right balance to ensure that we are exchanges are competitive. I think you're aware there is a lot of competition from the private markets, and as a consequence, we need the right frameworks that support and the right incentive models to support new issuances that are market friendly, that are proactive. In essence, every marginal dollar of investment these days, there's a lot of competition for every marginal dollar of investment. And even as arrangers work towards bringing out the best equity stories, the best credit stories to come to market, we fundamentally require more flexibility. And I think in the Kenyan context, we've seen the support of our local Kenya capital markets and the exchange in facilitating new issuances, and particularly those that are of a non-vanilla nature, and that has also led to further deepening of and allowed arrangers to come up with better, more structured products that also meet some of the evolving needs of institutional investors.
One of the challenges we face is that I think something which has also been mentioned by our chief guest this morning. The design of our stock exchanges are designed to fit the investor who is international. Okay? We have to rethink, and I suggest that ASEA considers having maybe 3 kind of markets running side by side. One, yes, which is internationally, benchmarked to receive capital from the Western world and back and forth, and other international, very professional investors. A middle market, which is basically for emerging African businesses, which are yet to get comfortable with the stringent regulations of the market. And then the third one is the African market, which is a market for the SMEs. Here is where I would say we need to have literally no regulations. Normally, I think I suggested in one of the meetings we had with the capital market players that you create a crush, like a cattle crush, which receives all the animals and then channels them into one, and then they get in, and finally they cannot reverse back. So in other words, we bring into the market, and I think the Nairobi Securities Exchange, where I've also served as a director for some time, as a market called IPUCA, to really bring this kind of people. So I'm suggesting that we have actually been doing things to benchmark with international stock markets. I think it's time we did an African structured stock market to fit us, and then one which is dealing with the low end of the market.
So from our perspective, and I also have the advantage of dealing a lot more intimately in the market as a range of issuances previously. And there's definitely been an evolution in terms of how the market has evolved. You know, it was long settlement days, paper-driven, etc., to now a more digital-driven platform. But it's still not there yet. I think we do have opportunities to look at 24-hour trading being a lot more convenient as to how you transact on your phone, etc. We are working with the Nairobi Securities Exchange as it is around launching in the next couple of coming weeks a product where you can actually trade on your phone at your convenience, and it's geared towards that segment of society that wants to participate, that doesn't have the time to actually engage the stockbroker, wants information as to how stocks are performing, make quick decisions on that trade, and have certainty that the transaction will execute. We've demoed it actually today. It's called Mali. And it's that sort of innovation, I think, that will really help catalyze those pockets of liquidity in these markets that have not been fully tapped or fully engaged. Or for that matter, needs to diversify away from, in Kenya, you buy land if you have a bit of money, and the returns on land are not great at the moment. So the reality is that helping people diversify with comfort and security has to be a priority for the exchanges. I think there's still other innovation needs to happen. Innovations around how we get information out to the public around stocks, not just the share price or today's movements, but also in terms of informing them. They might have the same sophistication of analyzing P&Ls and balance sheets, but at least information that can help them make reasonably well-informed decisions, especially for the smaller stock traders.
The capital raising process has been made very difficult, if I tie to one of the concepts or points that was made here. It's been very suited to international capital. So that's a process that we are put through. Yet our people who are looking for capital are looking for very simple solutions. You've got traders who go to the market, they need X amount of capital in the morning, and by end of day they'll have paid it back. The interest rate for that day might be 10% for the day, but they're happy to pay it because they just need the capital for the day. Now, if you ask them for audited accounts, they will not supply. If you speak to a farmer who understands I've got a 3-month cycle, I need to plant, I need to weed and to harvest, and I'll be able to pay you back in 3 months. If you ask them for audited accounts, they will not be able to produce. So I think our innovation needs to be not about products that are nice and will hit the headlines of the Financial Times. Our products need to be around what are our people engaged in, what are the activities, where are the needs for capital, and how do we simplify it for them to be able to access the capital quickly. A lot of our stock exchanges are, you said we can be honest, eh?
Yes.
Okay.
Yes.
So I think a lot of our stock exchanges are subscale. In terms of, if you look at the trading activities, the number of listings and the like, they're quite subscale. Of course, now there are nationalistic interests. Countries want to have their exchanges, they want to have their own depositories and the like. But really, in the age that we are in, do we really have to continue honoring borders that were drawn up for us by other people who since left the continent and they left with their capital? Is it possible that we think about how we, of all these stock exchanges, how do we make it easy? If I have just one central depository account as an example, am I able to trade across the continent? Then the challenge is not just for the exchanges, even for the market intermediaries. How much information are you putting out there as far as what I can do in Ethiopia, which is just next door, what is available in Benin, as an example? Again, just institutional capital alone, we have over $1 trillion of capital on the continent. But a lot of it is either stuck in their countries, and also it's stuck in their countries. It is also not addressing the needs of capital in those countries. So I think there's definitely room for, we still have to make a lot more strides. I think maybe the challenge for all of us is to shed off some of these nationalistic interests that may not necessarily be actually addressing the needs of our respective countries.